Okay, when you hear the name Oracle, you probably think of, old school databases, maybe some clunky enterprise software from back in the day. But here's the thing, that Oracle is in the middle of a massive, and I mean massive, pivot. They're going all in on AI and the cloud. So the question for any investor is pretty simple. Is this a brilliant reinvention story in the making, or is it just a giant's last high-stakes gamble? Let's break it all down. Right. So at the heart of Oracle today, you've really got two completely different companies fighting for control. On one side, you have the legacy giant. You know the one, incredibly sticky, super high margin database and on-premise software. But on the other side, you've got this aggressive new challenger betting its entire future on winning in the brutal, hyper-competitive world of cloud and AI. And if you're looking at the stock, you have to decide which one of these stories is actually going to win out in the end. So let's start with the bull case. Why are so many investors suddenly getting excited about a company that, let's be honest, had basically flat revenue for almost a decade? Well, it all comes down to one thing: serious momentum in the cloud. Check out this number, $138 billion. That is Oracle's remaining performance obligation, or RPO. Now, in simple terms, that's future revenue that's already been contracted. It's money that customers have already promised to spend with them. And get this, that backlog just surged 41% year over year. That is a massive, flashing green light that tells you big customers are signing huge, long-term cloud deals. So where is all that business coming from? Mostly from Oracle Cloud Infrastructure, or OCI. That's the company's real growth engine. And what's crucial here is that its growth is actually accelerating. I mean, it jumped from an already really impressive 42% growth last year to 52% this year. That is the kind of hypergrowth that gets Wall Street really, really excited. Now, you might be wondering, how is Oracle defending its crown jewel, its database business, in this new cloud-first world? Well, they're doing it with a really clever and frankly pragmatic multi-cloud strategy. See, instead of trying to force customers to move everything over to Oracle's cloud, they're doing the opposite. They are putting their best database tech right inside the data centers of their biggest rivals, like Microsoft Azure. It's brilliant because it just removes all the friction for customers and protects that super lucrative database business. So the whole bull case really boils down to three key drivers. First, just massive, overwhelming demand for OCI to train all these new AI models. Second, you've got the steady, market share gaining growth from their cloud-based business apps, Fusion and NetSuite. And third, a huge strategic bet that they can completely transform the healthcare industry with that $28 billion acquisition of Cerner. Okay, but it's not all sunshine and rainbows. Not even close. Let's flip the coin and look at the bear case, because the challenges Oracle is up against are, well, they're enormous. The competitive landscape is just brutal. I mean, the cloud infrastructure market is basically an oligopoly. You've got AWS, Microsoft, and Google controlling over 60% of it. And Oracle, despite all that crazy growth, they're still just a tiny player at around 3%. They are literally trying to steal scraps from the table of these deeply entrenched giants who have massive, massive scale advantages. And trying to catch up is unbelievably expensive. Oracle is projected to spend over $25 billion in a single year just on capital expenditures. We're talking building data centers, buying all the GPUs needed for AI. That is a staggering amount of cash, and it puts immense pressure on the company's finances. And at the very heart of this whole transition is a really tough financial trade-off. They're moving away from their classic software business, which had these incredible fat gross margins, like north of 80%. And they're moving into the much more capital-heavy cloud infrastructure business, where the margins are closer to 71% and have actually been falling. That's a fundamental risk to the profitability that Oracle has been known for decades. So the whole bear case really zeroes in on these financial risks. You've got a massive debt load of nearly $93 billion. You've got that strain on cash flow we just talked about from all the spending. And then there's the huge, huge execution risk of trying to integrate that massive Cerner acquisition and move all of its tech to the cloud. I mean, there's a lot that could go wrong here. Okay, so we've got a really powerful bull case on one side and a pretty sobering bear case on the other. So how does this all shake out in the stock's valuation? What is the market actually pricing in right now? This is really the key question you have to ask as an investor. Is the market still looking at Oracle like it's that same old slow growth company of the past? Or has it started to give it credit for its future as a genuine high growth cloud and AI player? Well, if you look at how it's valued against its peers, it tells a really fascinating story.
On a forward PE basis, Oracle, at about 33 times earnings, is trading way higher than its old rival, SAP, which is down at 25 times. But it's still at a pretty noticeable discount to the big cloud leaders like Microsoft and Salesforce, who are up closer to 40 times earnings. So the market basically sees it as a hybrid, right? Something in between the old world and the new.
So here's the bottom line on valuation. The market is clearly buying into the cloud growth story. No doubt about it. The days of Oracle being valued like a no-growth company are over. However, that discount it has compared to the pure-play cloud companies tells you that investors are still hedging their bets. They are pricing in those very real financial and execution risks we just talked about.
So if you're an investor trying to follow this, how do you keep score? What are the key signals that are going to tell you whether the bulls or the bears are winning this fight? Let's build a quick dashboard of what to watch. All right, here are the 4 metrics that matter more than anything else. First, OCI revenue growth. That number has to stay up in that 50% plus range to prove the story is real. Second, RPO conversion. Is that massive $138 billion backlog actually turning into real revenue each quarter? Third, cloud gross margins. As they build out all these new data centers and fill them up, you need to see those margins stabilize and start to climb. And finally, operating cash flow. After this crazy spending spree, cash flow absolutely has to recover and recover strongly. You know, the entire investment case can really be summed up by this one key insight from the analysis. The ultimate trajectory of the stock will be determined by whether the bull or bear case prevails. Specifically, whether Oracle can successfully execute its massive build-out and convert its impressive backlog into sustained, profitable growth. And that brings us right to our final thought. Oracle has the demand. That's locked in. A $138 billion backlog proves it. And they have a massive, multi-billion-dollar plan to meet that demand. The fundamental question you, as an investor, have to answer is this. Can they build it all fast enough? And when they do, will the profits be big enough to justify this absolutely enormous gamble?